Below is an income statement for the Pavlik and changes in balance sheet accounts for the year. In addition, during the year, Pavlik sold long-term investments with a cost of $6 for $16, and land with a cost of $15 was sold for $9. Finally, we're also told that Pavlik declared and paid $30 in cash dividends during the year, and we're asked to prepare a cash flow statement using the indirect method. We're going to take two steps in our approach here. Recall our indirect method explains the change in cash, which in this case is a $5 decrease, by looking only at the changes in balance sheet accounts. So we're going to take that approach to start with and get a cash flow statement that balances using only our balance sheet accounts. Then we'll incorporate some of the additional information we're given on our income statement and about dividends and the sale of our long-term investments and the sale of our land. So again, to begin with, we'll consider only changes in our balance sheet accounts. Recall, when assets increase, we consider that a use of cash. When assets decrease, it's a source of cash. Let's begin with the $110 increase in accounts receivable. Since accounts receivable increased by $110, we'll list this as a $110 use of cash in the operating section of our cash flow statement. Inventory is also an operating activity. It decreased by $70, which will represent it as a $70 source of cash. Since prepaid expenses increased, this will be listed as a $9 use of cash. Long-term investments decreased by $6. The decrease in assets is a source of cash, and long-term investments is classified as an investing activity. Plant and equipment is also an investing activity, and plant and equipment increased by $200, so this is a $200 use of cash. Our accumulated depreciation, recall, decreases assets, and since accumulated depreciation increased during the year, we will say our assets decreased. Recall also, this is simply equal to our depreciation expense for the year. So we've got a $60 source of cash as an operating activity. Finally, the last asset we have is land. Land decreased by $15. This decrease in assets is considered to be a source of cash and is classified as an investing activity. On the liabilities and equity side of our balance sheet, increases in liabilities or equity provide a source of cash, while decreases are a use of cash. Accounts payable increased by $35. This increase in liabilities is a source of cash and classified as an operating activity. The $4 decrease in accrued liabilities will be a use of cash in our operating section. The bonds payable increased by $150. This is a financing activity and a source of cash. Deferred income taxes increased by $8. This is an $8 source of cash in the operating section of our cash flow statement. Finally, we have the change in common stock. Common stock decreased by $80. A decrease in liabilities or equity is a use of cash, and this will be a financing activity. Normally, our change in retained earnings will include two components. We might have an increase in retained earnings due to due to net income, and a decrease in retained earnings due to dividends. If we're only looking at the change in balance sheet accounts, we will have to assume that the entire $54 increase in retained earnings is due to net income, and we'll list that in the operating section of our cash flow statement as a source of cash. We've picked up all of the changes in the balance sheet accounts, so now we can sum up the cash flows in each one of the sections of our cash flow statement. Cash provided by operating activities is $104. The net cash used by investing activities is $179, and the cash provided by financing activities is $70. This gives us a change in cash of $5 decrease, which agrees with the $5 decrease on our balance sheet. Let's now go ahead and consider some of our additional information. We were told that cash dividends were $30 during the year, and our income statement shows net income of $84. Recall the change in retained earnings was net income minus dividends, and we had $84 in net income from our cash flow statement and $30 or from our income statement, and $30 in dividends. Let's go ahead and adjust our operating cash flows to reflect the true net income. So instead of $54, let's put in $84. So in other words, let's increase our operating cash flows by 30. Notice, not surprisingly, our cash flow statement no longer balances in terms of the change in cash doesn't equal the change on our balance sheet. We need to still incorporate the dividends, and the dividends will be a use of cash in the financing section. Once we've incorporated both the true net income of $84 and the $30 in dividends, our cash flow statement once again balances. All right, now let's go ahead and incorporate the information we are given regarding the sale of our long-term investments. We're told investments with a cost of $6 were sold for $16. This would have been our journal entry. We would have debited cash for 16 and credited long-term investments for 6, and of course a gain on sale of 10. So instead of $6 for the cash from the sale of long-term investments, we really received 16. Let's reflect that on our cash flow statement. Once we reflect that on our cash flow statement, the change in cash of $5 increase no longer equals the $5 decrease in cash on our balance sheet. And this isn't surprising since we increased investing cash flows by $10 and we didn't change anything else. That $10 gain on the sale is part of net income. So that's part of our $84 in net income, but has absolutely nothing to do with operating activities. So it increased net income, but doesn't relate to operating activities. So we want to deduct the gain from our operating cash flows. And we can see once again, our cash flow statement will balance. Now let's go ahead and consider the sale of our land. We were told that land with a cost of $15 was sold for $9. When we picked up the $15 decrease in land, we assumed that the decrease in assets was a $15 source of cash, and we recorded it as such on our cash flow statement. But notice, according to our journal entry and our description, we only received $9 in actual cash. So let's change the sale of land from a $15 source of cash to a $9 source of cash. Well, in doing that, suddenly once again our cash flow statement doesn't equal the change in cash on our balance sheet. Now, that loss on the sale, that's part of our income statement, and that would have decreased our net income, but has nothing to do with operating cash flows. So on our income statement, we will want to add back the loss on the sale. And once we do that, our cash flow statement again balances. One of the things you want to keep in mind is quite often in looking at a cash flow statement that a company prepares, you'll see that the changes on the cash flow statement don't necessarily equal just the changes in the balance sheet accounts. That's because the company quite often has additional information, say about gains or losses on the sale of assets, and other types of information that aren't readily apparent just by picking up changes in balance sheet accounts.